My name is Richard Amoedo. I am one of the co-founders of Investor Next Door Club and happy to have you on this masterclass session with us. We're going to talk about private capital raising, private money. We're going to talk about creative financing, and we're going to cover it in a relatively high level because we only have a little bit of time together. But those of you that have questions after, feel free to submit them. Sandy will drop those, we'll drop the email in where you can submit those, or you can drop questions in the comment section. I won't touch on those until the very end so I can keep the flow going. But one of the things I want you to realize when it comes to private money, creative financing, it is once you understand this, like once you start to grasp it, you really don't look at opportunities the same way. I think a lot of people, they look at an opportunity and it is they see it, maybe the certain dollar amount, the price tag, the down payment, whatever it is that comes to mind, and they immediately think, I don't have the money for that. I don't have the capital. So be it. But once you start realizing that all you're lacking is a little bit of knowledge, people, and resources, then everything becomes a lot more possible. The types of transactions that we are working on today that are in the tens of millions to hundreds of millions of dollars was not possible a decade ago, right? So there is a process. There's kind of like, when you're going to go to the gym and you start working out, if you're lifting weights, you're starting off with one weight and then next week you're a little heavier. And a couple weeks after you're a little bit more heavier, or you're getting more reps in or whatever it is. It's because you're getting stronger. This is no different. I think there's an entire industry out there that wants you to believe that it's out of your reach. And our job here in our community is to make sure you realize that it is within your reach. Maybe not today, maybe not tomorrow, but a whole lot faster and a whole lot quicker than you ever thought was possible. But the important thing is that you start. So I want to just kind of dive in on a few of the topics that I want to cover in this session to really hone in on so you understand what is really involved with private money and private capital. Anyway, creative financing, we're going to focus more on real estate, but really it can be used for anything. Anything that's got a value. People do this with buying a business, a small business, a medium-sized business. And even when you get into larger transactions, financing can get kind of creative because banks aren't a lot of fun to work with. And so we like to look at things just on a basic level. We look at, a couple of things. Most investors, they think they're locked out because they can't get approved with a bank, right? Or they don't have enough capital. Well, it comes down to a few things. When you're looking at a bank, right? They're going to be looking at things like how much capital you have right now, what can you do for a down payment, what reserves do you have? And then they're going to look at, do you qualify, right? Your W-2 income if you're not in business or a professional in real estate. They look at your debt to income ratios, tax returns, seasoning of the capital that you do have to make sure you didn't just get it yesterday. And then there's the speed. They killed more deals than they make happen just because they take 60 to 90 days. One of the reasons why I had a very successful asset lending fund was because we could approve deals in a matter of 24 to 48 hours, and we could fund within 3 to 4 to 5 days if need be, because we had everything we needed to make that deal happen. It wasn't based on their credit. It wasn't based on how much capital they had. It was based on the deal itself. So we're going to talk a little bit more about that. Now, there's three tools and three sources of capital: owner financing, asset-based lending, private lending. Owner financing is where the seller becomes the bank, right? We'll talk about some details about that. Asset-based lending, the property is your bank. Basically, it is the thing that you are lending against. It's not your personal income. It's not your credit. It's based on the asset itself, the house, the building, the land, whatever. And then there's private lending. This is where the individual also is your bank. Someone outside the deal is lending to the deal. Now that can be something that's more organized, or it could be an uncle. It could be a friend. It doesn't matter. But we're going to dive into, we're talking about owner financing. How is the deal structured? Well, when it comes to owner financing, it really is best when the seller owns the property free and clear. I'm not saying it can't get done another way. I've just never done it that way because I know there's some risk associated with it that I don't want to mess with the terms that the bank has in place. So when there's an asset free and clear, then we can look at things where You can do a smaller down payment, could be 5%, could be 20%. Sometimes it could be zero, right? But that's a rare case. The interest rate tends to be below market, could be even with the market, but it's flexible. And the terms, you could do a 30-year mortgage payment on it, just like you're familiar with. And this could be any size type property, but you're going to have a payoff because that seller, let's think about somebody who's 70 years old, they're selling a property. They don't want all the money right now. Maybe if it's a commercial property, they're going to have taxable gains. Like, hey, I don't want to take all that taxable gains right now, but I want to get these payments, but I do want to get paid off in the next 5 years, 7 years, 10 years, whatever it is. So you're going to have to refinance out of that at some point or sell it off. And then that way the original owner does get paid off. There's always going to be documents. There's going to be a note. There's going to be a mortgage. There's going to be a deed of trust, right? All those things like you would have with a normal deal. And any competent attorney can do those documents, and your title company can help you with that as well. Plus, you're definitely always going to close to a title company. Never do this just like signing documents in your truck and transferring. It's all got to be recorded properly. You want to make sure it's protected. And again, it just comes down to, do you have a flexible seller? And there's lots of reasons why somebody wants to not do a full payout day one. And a lot of it's going to have to do with tax, or they just want to have a certain amount of money coming in every month. And it's pretty risk free because worst case scenario, you stop making the payments, they just get the property back and they get to keep all the payments they collected, just like your bank would. So there's some risk that you could lose it if you don't make the payments. So they can still foreclose. They don't give up those rights. So talked a little bit about some of these things. Sometimes where this comes into play is, the seller wants a higher price than you want to pay. Well, there's price and there's terms. So it's like, listen, Mr. Seller, I'm willing to give you that price, which is higher than I want to pay right now today. But if you'll let me make payments on this and pay you out at this interest rate, I will get you that top line dollar that you want, but just it's not going to be all today. So it creates negotiating power, some leverage in it. And when you think about all the properties that are out there right now today, and there's a lot of them, baby boomers own a lot of commercial property that what I would say used to not be very attractive as an asset class, but has gotten very attractive over the past 5 to 10 years in storage facilities, RV parks, anything that's kind of mixed use, or if you've got a property that's a little distressed. There's a number of things that come into play with that, but this is why you want to have these conversations and find out why are they selling? Everything you can find out about the property, you can from the seller, from neighbors, from anything that's publicly available online, from tax records and ownership changes and things like that. Was there a death in the family? Did the property get left to a trust? Did it get left to a group of siblings? A number of things come in, but the important thing is to find out how flexible is the seller. You'll find there's a huge percentage of sellers out there that would perfectly be fine with having payments against an asset that they're very familiar with, because it helps them figure out what to do with their money. Because a lot of times they're not really sure what to do. If all of a sudden they're getting $1 million, $2 million, whatever it is, $10 million all day one, then that creates a level of responsibility and preparedness that they're maybe not be prepared for. So it does become attractive when they get to spread those payments out. But let's look at a small example. Let's say we're looking at a $400,000 duplex. There's no bank involved. The purchase price is $400,000. The seller's like, hey, I'll do this, but I want 10% down payment. Fine, I'll give you $40,000, right? And the interest rate is 6.5%. The interest rates are probably going up from the time that we're having this, probably in the next 30 days, and they're going to go up again before they ever come back down. That's everything we're seeing right now. And so you've got a nice, good interest rate. Compared to the world that I came from, that is a good interest rate. There was a season where we had very, very low interest rates, which got a lot of these commercial properties in trouble present day to day. But that seller is saying, you know what, I want to be fully paid off in 7 years. That property is not going to cash flow enough to pay it off in 7 years, but you would have enough time to where you could either decide how you want to exit that inside of 7 years. Do you want to do a cash out refi on that in 7 years? Regardless, they just want to get all their money by the seventh year. And you can structure that a number of different ways. But, a conventional bank, is going to require you to probably put $100,000 down. 20%, 25% down. Sometimes you can get something a little lower. There's different FHA programs out there, but that only works for a number of properties. And once you get over a certain point, you just can't do it anymore. But I would highly encourage you that if you're talking to someone about selling anything, have the conversation about them doing seller financing. Now, asset-based lending. This is where the property is the bank. Meaning it's the thing that holds it all together. So if you're buying something that is $100,000 and let's say it's worth 100,000, but you're buying it for 70. You can find individuals. You can also find companies that specialize in asset lending, and they'll usually lend up to about 100% of that purchase price. Sometimes they still may require a 5 or 10% down payment, but this is where they're just going to look at the property itself. They're not going to look at you. They're not going to look at your W-2s. They don't care what your credit score is. They're not pulling a background check on you, all those things that a bank would do. They're just going to look at, hey, are we protected with this asset? If you default, how are we going to get our money back? Well, it's like, we know it's worth 100,000. We're lending 70,000 on it. We got a 30,000 spread on it. And worst case scenario, we'll probably sell it for 75 or 80% of the value just to get it off our books quickly and go on down the road. Now, there's some organizations out there that do something that's known as they're predatory lenders. They lend to own. So it's okay if you pay it off. They're fine if you do that, but they're really looking at, wow, we'd like to have this property. I'm glad they found it. We're going to lend at a really high interest rate. And if they fail, no big deal. We just take the property back. So there's different strategies and there's different reputations that are out there with some organizations, and you just want to be mindful of who you're dealing with. It's always good to have a referral or a reference when you're dealing with one of those firms. But there's really three things when it comes to asset-based lending, and I'm going to start from right to left. So, bridge financing is really intended for very short term, but so is hard money also. But bridge is just there to kind of move quickly. It is typically more expensive than hard money, but again, it's still based on the asset. The hard money option usually goes a little bit longer. People that are doing fix and flips, maybe they're doing a buy hold and they're going to refinance at it after they get a tenant inside of there. Well, the way you exit a hard money loan is you go to a DSCR, that's a debt service coverage ratio. And what they're looking for is, does the rental payment cover the mortgage that's going to be putting in place? And they're usually looking for a 1.25 multiple on that. So they want to know you got an extra 25% above the rental, that you've got enough cash flow just in case you have a month or two where you're not renting it out. It becomes a lot more challenging on just a single family. When you start having a duplex, triplex, fourplex, or you go into multifamily, which is 5 units or more, then you've got a little bit more margin, a little bit more wiggle room, but they're still looking at, how is that thing going to cash flow with your current rent roll, and will it be able to support the debt payment? And that is a permanent, a DSCR is asset based on the rental income, how it's performing as a business. And that can be, you could have a 25-year mortgage on that, right? Or even up to a 30-year potentially. Sometimes they'll have a period of time in there where you're going to have to refinance, depends on how long it's fixed for. But that is still considered to be more permanent financing that is done by a bank, but it's because it's already proven that it does cash flow. But again, it's not based on you, your credit, or your current income. It's based how that property is performing on a cash flow basis. So when you look at speed and flexibility, it comes at a price. But what you want to be able to look at is, how fast do you need to act on this? And sometimes that is going to dictate if you got to start off with bridge or hard money. Or again, if there's no pressure from the seller and they've got time for you to figure things out, you could see if you could get a DSCR. But just know your first time DSR with no experience can play a factor. but you are looking at where you're going to have some kind of down payment, some kind of asset, and the credit restrictions have gotten a little bit flexible also. So this 660 number for credit on a DSCR is definitely not required. Typically, you're not having to prove a lot of stuff, but you do have to prove that the property is going to perform because most of these lenders, they do not want the property back. You can get things done very fast. A DSCR is definitely going to take 4 weeks because you're dealing with bank financing. When you're looking at hard money and bridge, that could be very, very quick if you've got all your ducks in a row. But most of the time, borrowers do not have all their ducks in a row and they got to get this paper, this document, what have you. And that just chews up time on the clock. So I always tell people plan on 2 weeks to get bridge or hard money done, plan on 4 weeks, sometimes a little bit more depending on the season of the year. And you can check in with your lender on that if that's going to take longer. Once you have more experience, things do go a lot quicker. Right? Now, the rates are going to vary depending on the deal itself. And if you're using bridge, hard money, or DSCR, DSCR is going to get you your best financing as far as interest rate, cost of funds, but bridge and everything is definitely going to be higher. You should anticipate double digits, and you could see things as high as 12 and even 15%. But again, those are short-term solutions. So you've got to have a good strategy and you got to have a good exit plan of those things to get into some kind of permanent financing, or you're flipping out of it, whatever you're doing. Now, when it comes to private lending, this is where the individual is actually acting as your bank. Now, this could be friends, family, somebody in your network, somebody that's got self-directed IRAs, or they've got a solo 401k. They've got some kind of discretion how they can use the funds that are in those retirement type accounts. Or you're looking for, investors that are seeking a higher yield than maybe what the stock market is doing on a given day basis, but they have enough disposable income, cash in retirement accounts or savings or whatever it is that they can fund these types of things. And it's no different other than you got to prove up the asset. They got to trust you. They're not looking at credit. Down payment can also be very flexible. They might even do up to 100%. They're probably doing something short term. Could be 6 months, could be a year, could be 2 years. It's whatever you structure with them that they're comfortable with. I've seen private lenders go into deals for 60 months. That's 5 years. That gives you a lot of flexibility. And here's the thing, it doesn't show up on your credit, right? It's off book balance stuff. Now, deal anatomy when it looks at this when it comes to private lending, we've got, you're going to do a promissory note and a mortgage. The interest rate, again, it's whatever you negotiate. It's going to be probably a little higher than the going rate. And it could be up to 12%. It could be higher. It doesn't matter. But most of the time, private lenders, they're looking at 8 to 12%. Conservative, asset backed. They got the security. They've got some kind of equity that's built in because you bought the thing at a discount. If you're not buying at a discount, they're probably going to require you some kind of down payment because they don't want to be upside down if they take that property back. Terms, again, 6 months to 5 years is certainly possible. They're going to take a first lien position. So if you default, they're going to foreclose. There are some private lenders, no one sophisticated that I know of is doing any second liens. Someone unsophisticated might do a private note as a second lien. That is going to have to be a very trusted relationship, someone that believes in you. So I wouldn't bank on that. I would always bank on the first lien position is always the strongest position. Well, let's kind of look at a win-win scenario. Let's say it's a family member. They've got 150,000 sitting in savings. It's earning 4% maybe. They're looking at, if I could get 9% on that money, that would generate over $13,000 a year for them. That's, more than double what they're getting right now. And it's backed by a hard asset that you are either going to cash flow or you're going to exit and refinance out of or sell, whatever it might be. So it's a pretty safe scenario for them. It's not a complicated thing. You might have to educate somebody on it, but you want to be careful that somebody that is not really comfortable with this type of transaction, don't leverage your relationship because it can get annoying if they're asking you every single month, when are you exiting? How's it going? You need to go with a clear plan. They need to understand their exit for themselves. And just be careful about talking someone into doing a deal with you because it can be bad for both of you, my personal opinion. Now, you want to stay on the right side of the line when it comes to anything associated with money. So, borrowing from people in your existing relationships is generally fine. Soliciting strangers is not. Even as a private lender, maybe you get introduced to somebody, that's fine, but you don't want to be soliciting and looking for these private lenders if you don't have any kind of relationship with them whatsoever. So, because that's when we can start getting to securities issues. And that's why I talk a lot about how to avoid scams, talk a lot about securities laws. How do they apply to private citizens, private investors? Because you need to be mindful that you're not crossing that line. So make sure you're just dealing with trusted relationships, people that know you, or you're working off a really good trusted relationship that's a referral that you spend some time with getting to know each other and both parties are comfortable with that transaction. Now, if we look at a side-by-side, kind of comparison tool, you might want to snapshot this or catch the recording and relook at this section. When we look at owner financing, the source is the seller. We look at asset-based lending. We're usually talking about somebody that is a little bit more sophisticated or a formal sophisticated firm, like an institutional type lender. When we get to private lending, the source of capital is coming from an individual, right? So the due diligence is a lot different. It's a lot less scrutiny. It's completely between you and that individual. Same thing with the owner financing. It is between you and that individual. They own the asset. They're willing to part with it for X, Y, and Z. You come up with those terms, and everyone gets a win-win when it comes to that. The speed is what I mostly look at. I don't really look at cost of funds the same way as maybe most consumers would look at because I look at what the gain is going to be, right? So if it's going to cost me 6% to make whatever, 50 or $100,000 profit, I'm okay with that, right? So we just got to look to see, do the numbers make sense? Don't get fixated on a certain interest rate. Just make sure the rate and terms that you're setting up, that you're signing your name to or your company's name to, that it works for you. It's going to get you what you're mostly looking for, out of that deal. And the great thing is that once you do a successful deal with any one of these categories of people or institutions, the next one becomes easier. The next approval becomes easier because now you're building up a track record. The hardest thing to do is the first one with anything, which is why a lot of our community members would do things, combined together versus going on their own solo, giving up nights and weekends and all the things that go with that. But we always want people to know that there's options to do things on your own. There's options to do things together as a community. Takes less risk, less responsibility, but the returns can be almost about the same. Now, three-question filter to kind of go through when you're looking at things. Who has the leverage? If the seller is motivated and the property is free and clear, start with owner financing. See what their situation is. They may not want all that money right now, today. Two is what's my exit and when? Is it a long-term hold? Are you going to go into some kind of, DSCR right after that? Or we're looking for short-term value add, then sell? Just figure out what the exit's going to be. You've got to know what your exit is before you actually put that thing under contract, even way before that. You should have what you're looking at doing. And then whose money is closest to me? Is that a private lender in your network? Is that a friend that knows a private lender? Someone that can fund relatively quickly. And, or is it again, someone that you could get a good referral to that you can have, at least an introductory call with to make sure that this is a good fit. I just believe that no matter what the deal is, if it's profitable, you can find somebody to fund that for you or with you. One of the two. And maybe you do a JV on it. You take a little bit more spread than they do because you're doing more of the heavy lifting and whatever it might be. But just what I want you, no matter what I want you to get mostly at the end of this and really understand is that nothing is too big for you as long as you have a little bit of knowledge through the people that have knowledge also to support you or that can connect you to money, and then whatever resources you can pull together with other firms, other people, whatever it might be. How can you make this deal work? And yes, there is a possibility that you could bite off something, too big to chew because it's again, you've not done enough reps, right? You do have to put the reps in. I do meet people often that, they've never done anything, and the first deal they come up with is a $10 million deal. Well, they're going to need some partners on that, right? They're going to need some help. They're going to need some support because they've not proven that they can do that type of transaction. So it is a process, but where you start can be a lot bigger than what you're thinking you can start with. This is what happens a lot of times with people, why they don't get into commercial real estate sooner than later, because they see all the zeros and they're like, oh, that their mindset is that's too big for me. And maybe it is, but with enough people and enough resources, it's not. But this is why people get stuck and just sticking with small residential stuff that is gotten very competitive and very hard to work inside of unless you're going into niche type opportunities. Fix and flipping has become very challenging because everyone's going after the same houses. Renting out a house, the cash flow has been very, very risky because it's very, very thin margins. Interest rates are high. Then this supports all of it. So it becomes challenging. When you start getting outside of the residential single family bubble, you start creating up a whole different world because now you're entering into a world of commercial revenue. Even though it still might be residential, you're opening up to commercial revenue models, or you're actually going into a full commercial type asset class, whether it's storage, RV, etc., RV parks, whatever, mobile home parks, all those things fall into a commercial class at that point. When you get into the commercial world, you have a lot more flexibility to negotiate with people, and you get a little bit more firms out there that are wanting to get more footprint in those asset classes. So, my personal opinion, you can go compete in a red ocean, or you can go compete in where the ocean's a lot more blue and a lot more options are. And the reason why is because most people think they're not ready. And, you know, I think if you're willing to start taking a stab at having those conversations, you'll find, even though it's almost like practicing with, playing Monopoly, you're playing with Monopoly money, right? You can have conversations, they cost nothing. Just don't overpromise and underdeliver, right? You could start a conversation, start learning, start running through the tires, start getting that experience and comfortableness of talking with people, even though you're not going to do the deal. Or you come back and you bring the deal to the community and we start talking about it. And now we have a real life, not a hypothetical, we have a real life thing that we can play with and that we can kind of go through the due diligence together and underwrite that to see if it makes sense. So that's why we do that in our community. But I appreciate you being on with us. Look forward to seeing you on the next session. Bye for now.